Good afternoon, everyone, and welcome. My name is Emily Martin. I'm NCEDA's Program Manager, and we're excited to have you with us. Before getting started, we'd like to review the logistics of this webinar platform. You'll see on the screen a few important logistics to read through as attendees. To reiterate, all attendees are muted and will stay muted during the presentation. The best viewing option for your screen is called Speaker View, which you'll see as a viewing option at the bottom of your screen. We will have a live Q&A session at the end of the presentation. During that segment and any time during the presentation, you can type your question into the Q&A box. To access this option, click Q&A at the bottom of your screen and then type in your question. These questions will be addressed at the end of the presentation. If we are unable to answer all of the questions live, NCEDA will send out a response sheet to all participants afterwards. Keep in mind we will be checking the Q&A box, not the chat box, so be sure to use that feature to ask questions. This webinar is being recorded, and a link to the recording will be sent to all registrants to use as a resource afterwards. At this time, I'd like to introduce our NCEDA board member, Josh Hollingsy, who will offer welcoming remarks and introduce our presenter.
Thank you, Emily. Greetings from a very hot and muggy Brevard, where our Economic Development Office doesn't have air conditioning today, so we're awfully muggy. I'm Josh Hollingsy, Chair of NCEDA's Professional Development Committee. I head up the Transylvania Economic Alliance. It's my pleasure to kick things off today. This webinar, New Tax Considerations for 2020, presented by DMJ Company, is the latest edition of NCEDA's webinar series. And today's learning event promises to be a valuable one. We're going to find out about safe harbors, forgiveness, relief, and other terms we've never thought we'd hear from a certified public accountant. So thank you for our expert. All this as the Congress considers a fourth round of pandemic stimulus as we speak. And it won't likely be the last fiscal stimulus we see this year, believe it or not. And we still have 5 months left to go in 2020. I'll introduce our guest expert, Drew Haddock, in a minute. Before we begin, I'd like to take a moment and really thank our NCEDA staff. Emily, who you've heard from, Liz and Lawrence, they do a wonderful job pulling these virtual meetings together. And I'd also like to thank DMJ Company for their sponsorship of today's event. We're grateful for their support and professional development of NCEDA and their dedication to North Carolina's economic development community. I'm going to ask Emily to scroll through the names and logos of all of our annual sponsors. Thank you, Emily. These companies and organizations are committed to NCEDA, its mission and programs. Our sincere thanks go out to each of these sponsors whose support of NCEDA makes our programming possible. The COVID-19 pandemic has affected every layer of government, and that includes what we tax and how we spend. Today's guest has a handle on this topic, Drew Haddock. Drew is a partner at DMJ Company. He works out of the firm's Sanford office, where he conducts tax planning and compliance for corporations, partnerships, and individuals. Drew specializes in closely held businesses across manufacturing, distribution, real estate, and other industries. He's been with DMJ since 2017, and he has a lot to cover today, so I won't eat into his time. We're grateful for Drew sharing his expertise, and I'll turn it over to him now. Thanks, Drew.
Thank you, Josh. Thank you for the introduction. I am thankful that I do have air conditioning in my office today, although it does feel a little bit warm. I don't know if I could do this in a non-air conditioned office. But thank you to NCEDA for having me, and DMJ is proud to sponsor and support NCEDA. Just real quick, DMJ, we are a full-service accounting firm. We're headquartered in Greensboro, North Carolina. We have an office in Durham and Wilmington, and I sit in our Sanford office. I wanted to spend some time today talking about several key tax considerations or business incentives that have developed and continue to evolve during 2020. It is my hope that you learn something new from this information today that helps your business, you personally, or a business in your community through your knowledge share. At DMJ, we strive to partner with our clients to help them succeed. As with any partnership, we are only successful when those we serve are successful. So as we go through these slides, as Emily mentioned at the beginning, please put your questions in the Q&A box. I'm going to pause after my brief discussion. It won't be so brief, but my discussion on PPP, and field questions on that topic as we get there. You'll see here on my intro slide that I hope, oh, I need to share my screen. That just reminded me. So I'm sharing my screen now, and hopefully everybody can see that. I don't have any commentary, so if you can't, please, panelists, unmute yourself and let me know. But you'll see here on my intro slide, I put what we know as of July 27, 2020, because this year we have had weekly, sometime almost daily changes. We are expecting additional legislative changing in the coming weeks, as Josh mentioned, and as some of you may be hearing in the news. And I will touch on some of these rumors and some of these items that are kind of floating around out there in the news right now as we go through. All right, so the first thing and what I'm going to be covering is on March 27, 2020, President Trump signed into law the Coronavirus Aid, Relief, and Economic Security Act, or the CARES Act. Congress loves a good acronym, and so this CARES Act, lets us all know that they care about us. The sentence I will be covering today all come from the CARES Act or amendments to the CARES Act. There have been other changes this year, but the CARES Act is the largest and I would say the most relevant for the majority of businesses and individuals. So here are the topics and the sentence that I'm going to be talking about. The Paycheck Protection Program. And before you close out of your webinar, because you hear PPP and you think you've heard everything over the last 5 months that you want to hear about PPP, know that there have been significant changes over the last month or two, and there's also talk of an additional round of PPP funding. So I do think it's important to discuss this program again today. I'm also going to talk about the Economic Injury Disaster Loans, or EIDL, employee retention credits, change in net operating loss rules, qualified improvement property fix, personal tax rebates, and special relief from retirement plan rules for individuals. And so I did put 2 points in here at the end. I do want to talk about some individual tax relief items for those of us on the call who may be looking or may have family members or friends that want to know what's out there or what may be coming. So the Paycheck Protection Program. These are loans designed for small businesses under 500 employees with some exceptions. Notice the some exceptions. Businesses with more than 500 employees are eligible in certain industries. Restaurants and hospitality industry are eligible as long as there's no more than 500 employees per location. So you may have heard of Ruth's Chris or Shake Shack, who I believe returned their PPP money. Some of these really large companies that you're scratching your head and you're saying, how did they get a PPP loan? Well, there are exceptions to the 500 employee limit, and so these companies were able to qualify and participate. The maximum loan amount is 2.5 times 2019 average monthly payroll, up to $10 million. The program is administered by banks under guidance from the Small Business Administration. And I'll also put right here, the SBA has been really helpful. If somebody has a specific question, you can go on their website. They have a phone number and they actually answer the phone. And they have been very helpful in answering questions. So I would encourage folks to check out that resource. The PPP program was initially funded with $349 billion. That quickly ran out within 14 days, and then people started having heartburn and returning the money. $310 billion of additional funding was provided on April 24th as part of the Paycheck Protection Program and Healthcare Enhancement Act. And these loans are designed to be forgivable if the funds are spent appropriately. And so that's why everybody wants to participate in this, is because it's forgivable. It's free money. This program is administered by the banks, and I remember at the beginning in April when this came out, we had many clients who were calling us and wanting help with the application. And we were right there trying to help with the application process and gathering up information. And many times we had to say, look, the bank is approving this, this bank is requesting this documentation, this bank is requesting that. You essentially have to work with your lender to get approval and get them the information that they want. So the loan program was originally set to expire on June 30th, 2020, and that day is come and gone. And as of July 24, 2020, there was an estimated $130 billion in loan money remaining. So on July 4th, that was a misprint. July 4th, 2020, there was an estimated $130 billion in loan remaining. Also on July 4th, President Trump signed into law the PPP Extension Act, which extends the application period for the loan until August the 8th, 2020. So you still have time. If you have been on the fence and maybe your business was doing well back in April, May, and June, but now your pipeline is kind of running dry and there's a lot of economic uncertainty on your business and your revenue moving forward. Well, maybe now you want to think about participating in this program. Unfortunately, many large banks, some of the really large banks, stopped accepting PPP applications far before the June 30th cutoff. And I'm really not sure. I haven't had too many comments on if banks are. I assume most banks are still accepting applications, but I know people have had really good luck with online lenders that are still a good option: Cabbage, PayPal, Lendio. So if you're on the fence, and first check with your lender and your bank and see if they are still participating in accepting applications. And if you have trouble there, maybe go to these online options. A little information. So the Paycheck Protection Program, this is public information. Participants are made public by the SBA. And this is another reason why at the beginning, I think people started paying it back once they maybe thought about this, their company name would become public. The SBA says that they value transparency. And so loans larger than $150,000, the company name is made public and you can actually go out and download that information. The actual loan dollar amount that the company received, you won't see that, but you will see a bucket of between $150,000 and $1 million and so on. Loans under $150,000 remain anonymous, and so if your loan amount is less than $150,000, then you will remain anonymous. And so as of July 24th, this is hot off the press. North Carolina businesses, since we live in North Carolina, and I assume everybody on this call lives in North Carolina, and those are our communities, have received, I need to make sure I get this number right, it's a very large number, $12,184,819,684 worth of PPP loans, a total of 124,625 loans. And if you're doing the math at home, that's an average loan size of just under $98,000. So as Chris Farley would say, wow, that seems like a lot and seems like a really good stimulus for North Carolina businesses. And I hope that continues to be the case. I was just impressed. I was able to put this gift into my PowerPoint slides. So let's just talk about, I want to get to, what is probably on a lot of people's minds who have received the PPP loan is, how do I get it forgiven? And so to kind of get to that point, we've got to kind of work our way to that. And so we're going to start with the PPP covered period. And the covered period is the period of time that a borrower's use of the funds is analyzed to determine loan forgiveness. The original covered period was 8 weeks, which begins on the date the lender makes the first disbursement of the PPP loan to the borrower. So very early on, restaurants and gyms were very concerned because they were completely shut down, and gyms still are here in North Carolina. So they wanted to delay the start of their covered period until they knew they could reopen. And unfortunately, the SBA and the Treasury said, no, your covered period starts as soon as you get the money. Well, then entered the PPP Flexibility Act that was signed on June 5th. extended the covered period from 8 weeks to 24 weeks. Well, that's a heck of an extension, but not beyond December 31st, 2020. So for loans received before June 5th, the borrower can still elect to use their 8-week covered period. So you're going to have a decision to make. I mean, maybe you received your loan in an 8-week time period, you know that you have spent it appropriately. Well, you can still use your 8-week covered period. Early forgiveness applications can be utilized by borrowers who need more than 8 weeks, but less than 24 weeks to spend their full amount of the loan. So if you are between 8 and 24 weeks, you can do an early application for forgiveness, let's say 12 weeks. But it's my understanding, until something changes, that all your certifications will still be based on a 24-week covered period. So you will be applying for forgiveness at 12 weeks, but you're going to certify, hey, I'm not laying anybody off. I'm not reducing pay, for the 24-week covered period. If you move to that route, if you stick to the 8 weeks, then that will be over. All right, so what costs are eligible to be forgiven? During the covered period of the loan, the sum of the below costs are eligible to be forgiven. Payroll costs. Payroll costs, that's the whole point of the program, is to keep employees on the payroll. And so payroll cost includes salaries, wages, commissions, and similar compensation for employees capped at $100,000 per person on an annualized basis. Payments for vacation, parental, family, medical, or sick leave are also included. Severance pay is included, and payments for group health insurance benefits are also included. Any payment of interest on any mortgage obligation, real or personal property that was incurred before February 15, 2020 is also included as an eligible cost. That doesn't include credit card interest. It has to be interest on a mortgage obligation. So the loan has to have been in effect prior to February 15th, and it must be secured by real or personal property. Any payment of rent under a lease agreement enforced before February 15th, 2020, that's also an includable cost. And this is an interesting one. I had a client who was in the middle of moving offices, and so they signed a new lease agreement just after February 15th. And unfortunately, I don't think this was meant to catch them up in kind of this loophole of a disallowed rent expense, but it did. And really, I think what this is after is more of the self-rentals or the changing a lease agreement to up the rent so that you can fully utilize your PPP money. That's what this is after, but they were kind of caught up in that. And there's others out there who probably moved and signed a new lease agreement after February 15th who may also be affected. Any utility payment, electricity, gas, water, transportation. I get a ton of questions. We get a lot of questions on transportation, mileage, fuel. Transportation is open to interpretation. We have not seen any specific guidance on transportation. And so if you're down to the nitty gritty and you need to include additional cost, transportation, include it. Try to include it to your lender. Ask your lender, ask the SBA. Telephone and internet, all of which services began before February 15, 2020. And you can also refinance an SBA economic injury disaster loan that was made between January 31st, 2020 and April 3rd, 2020, and roll that into your PPP loan for forgiveness. So hopefully with the new 24 weeks, everybody is really, the payroll cost element is the big one. And hopefully most people, since this whole program was based on 2.5 months of average payroll from 2019, hopefully with 24 weeks of payroll, you can use all your payroll costs to achieve the forgiveness. You don't even have to worry about rent, interest, or utility payments. So let's talk about this 60-40 rule. 60-40 rule states that at least 60% of your loan must be used for payroll costs over the covered period to be eligible for full forgiveness. Any less than that and the loan forgiveness is reduced. So the original rule was 75-25. And so this also limited how you couldn't get a PPP loan and decide, hey, I'm not going to pay any employees. This is going to be used. I live in a high rent district. I'm going to use it all for rent and utilities, and use my PPP money for that, and not even use it for employees. Well, this is why this rule is in place. And so I just got a brief example here. A business receives a $1 million PPP loan, spends $500,000 on payroll costs, and $500,000 on rent and utilities. Well, that's a heck of a lot of rent and utilities. So the way you would determine it, obviously you didn't spend at least 60% on payroll. So you would take the $500,000 of payroll expenses you used it for, divide it by 60%, and that's the maximum amount of loan forgiveness you can have. And so you had a $1 million PPP loan, only $833,000 of that would be eligible for forgiveness. All right, PPP forgiveness. So this is what I wanted to work up to, as a lot of you may be getting to the point where you want to start thinking about applying for forgiveness. And I think the SBA just announced last Thursday or Friday that they're going to be accepting lender applications for forgiveness on August the 8th. So I'm not even sure a lot of lenders are accepting forgiveness applications. That they may be starting, or they may have recently started, but this is a lot for the banks. So if I spend the money correctly, what else do I need to do to make sure my PPP is fully forgiven? Two very important items remain. You have to spend it correctly, and then you can't reduce any full-time equivalent employees, and you can't have any reductions in employee wages by more than 25%. The SBA and the Treasury have defined an FTE as any employee who works 40 hours per week. So you have 3 employees. One is full-time at 40 hours a week, and 2 are part-time at 20 hours each. Well, you have 2 FTEs. Or if you had 1 at 20 hours a week and 1 employee at 40, and you have 2 employees, you have 1.5 FTEs. That's how that works. And so you may be looking at, well, how do you determine a reduction in full-time equivalent employees? Now, I'm not going to get into examples because it gets complicated. So I'm going to try to keep it high level, which is against CPA's nature. But reductions in FTEs is compared. So if you think you had a reduction during your covered period, it is compared to the lesser of 2 time periods. So you look at the average FTEs per month between February 15th, 2019 to June 30th, 2019, or January 1st, 2020 through February 29th, 2020. What were your average FTEs during those 2 periods? So whichever one was lower, you're going to use that one. And then you're going to see what your average FTEs were during your covered period. As long as your FTEs during your covered period were more than that other period, then you're good and you didn't have a reduction. If they're less, then you're going to have a reduction. Same thing with wages. You got to look at wages by employee. And so you would look and see, did I have any reduction in wages by employee as compared to the first quarter of 2020 annualized? And that you have to look at it by each employee. So let's look at 2 additional safe harbors. The SBA and the Treasury, in my mind, are really trying to bend over backwards to help people get full forgiveness. And so let's say if you reduce wages or laid employees off between February 15, 2020 and April 26, 2020, and you rehire and restore them by no later than December 31st, 2020, your forgiveness will not be reduced. So how long must you restore those employees for? Well, nobody knows. 1 day. This is to help folks who had to make adjustments to their business before the PPP loan program began. I think the CARES Act was signed on April 26th. And so that's when the PPP program began. But, this COVID thing, really started at the end of February and March. And so a lot of businesses out there may have already started making adjustments to the number of employees or reducing wages. And so this gives those businesses a chance to restore those employees. And then the next safe harbor here, if government guidelines from the CDC, HHS, OSHA, or state and local laws related to sanitation, social distancing, or other safety requirements kept you from operating at the same level of business activity as before February 15, 2020, then you don't have a reduction. It's a good faith estimate. So if you're a business that under government regulations, you can't operate back at the same level that you were, then and you have to reduce your employee hours, there's an exception for that. And let me see, I'm gonna go back one slide. So on reductions in FTEs, also forgot to mention, reductions do not include voluntary resignations, voluntary hour reductions, being fired with cause, or you had to lay off or furlough and then offer to bring that employee back at full pay and they refused, or you try to rehire a similar qualified employee. So if any of those things happen, just make sure you document, or the business documents, and you keep that in your records in case your loan or your forgiveness is ever looked at by the SBA. All right, so we made our way all the way through how do we attain full forgiveness. Now, how and when do I apply for forgiveness? This is where a lot of people are at today. Loan payments become due, principal and interest, 10 months after the end of the covered period. The maturity date of loans issued before June 5th, 2020 is 2 years. And for those PPP loans issued after June 5th, is 5 years. And you can actually try to go back to your bank if you need to or want to, and try to renegotiate if you have a 2-year loan, making it 5 years. Loan forgiveness applications can be submitted anytime on or before the maturity date of the loan, including before the end of the covered period. So there's 2 application forms. Form 3508, which is the full application, and in my mind, it's pretty complicated, especially if you have a number of employees. And then there's Form 3508EZ, short form. So 1 page plus certifications. Well, this is probably the form that everybody is going to want to use. And in order to use this form, you must meet one of 3 requirements. And so this is a picture of the instructions of the EZ form. And it essentially tells you what the 3, you have to check the box of one of these 3 items in order to be able to use this application. And so the first box is if you are self-employed, an independent contractor, or a sole proprietor who had no employees at the time of the PPP loan application and did not include employee salaries in your PPP loan amount. If you can check that box, well, you can use the EZ form. Let's see. The second box is if you did not reduce any employee salaries by more than 25%. Again, you're allowed to reduce an employee salary up to 25%, but not by more, during your covered period, compared to January 1st, 2020 through March 31st, 2020. And the borrower did not reduce the number of employees or average hours paid to employees between January 1st, 2020 and the end of your covered period. If you didn't reduce wages and you didn't cut anybody's hours or any employees, you can check that box and you can use the EZ form. And then the third box is if you did not reduce employee salaries by more than 25% and the borrower was unable to operate during the covered period at the same level the business operated before February 15, 2020, due to compliance with requirements or guidance issued between March 1st, 2020 and the end of this year by DHHS, CDC, or OSHA related to social distancing, sanitation standards, or any other work or customer safety requirement. So if you didn't cut anybody's pay, but you were operating with less people because of these government requirements, you can check that box and you can use the EZ form. So let's talk about current proposed legislation. These are both subject to change. This is samples of what has been floating around Congress. You all may have heard of CARES Act 2.0, and that's the current $1 trillion stimulus package that Congress is working on. And these are some ideas that have kind of been floating around. And the first one is prioritized paycheck protection program. Essentially, this is a round 2 of PPP loans that will be available to businesses with under 100 employees, and they'll be eligible to apply for a second loan. You must have used up or be on pace to use up your full original loan. And also, this is an interesting one. This is where Congress is trying to put in, hey, we want to give an additional round, but we also want to make sure this goes to businesses who most need this. And so you must be able to show a 50% loss in revenue due to the pandemic. Again, this is just what's been floating around as part of this next stimulus package. And the next one, which I'm really pulling for, and I'm sure everybody in the banking industry is pulling for, is the Paycheck Protection Small Business Forgiveness Act. This would be automatic forgiveness of loans that were $150,000 or less. And so the average loan size in the whole country is right around $100,000. So if this is the case, then the borrower would sign a 1-page attestation form and essentially just certify that you spent the money appropriately, and you would get full forgiveness. That would really be probably a great relief for a lot of the banks who are trying to administer all these loan forgiveness applications on top of loaning all the PPP loans they've already done. So with that, I'm going to pause right here, and maybe Josh has got some questions, and I'm going to try to answer them the best I can. If there's anything too specific, I'm happy to talk with you after the webinar, and feel free to email me or give me a call. Josh, any questions out there?
We're not seeing any specific questions right now on PPP. I'll say as a personal commentary, I appreciate any accounting presentation that includes Chris Farley. So that's much appreciated.
This is what I look like, Josh, at the end of, we've been drinking from a fire hose on all this information. And so trying to keep up with everything coming out, I think this is what a lot of bankers and accountants probably look like.
I definitely believe that. We did get a question in from Robin. How do you calculate the amount of available if no employees but owner operator?
So it depends on how your business is organized. When you say owner operator, I'm thinking of you are a Schedule C business. So you file a Schedule C with your personal tax return. And the way that is calculated is they look at your 2019 Schedule C, and that divided by 12 times 2.5 is essentially how they come up with 2.5 months of your average pay. And then the next question everybody always wants to know, if you're an owner operator, Schedule C filer, will it be forgiven? And essentially, if you didn't have employees and you get a PPP loan, as an owner operator, the full amount should be forgiven. I don't see any issues with your amount being forgiven.
Thank you. The next question that we have, can you revisit the ability to apply for forgiveness before the end of the PPP covered period, and what will be required with that?
So you can, and you can apply for forgiveness before the end of your covered period. So this is for people who their covered period is now 24 weeks, and maybe you only need 12 weeks to fully use up the PPP funds. I was talking with somebody earlier today, and I have not seen a definite on this. I know that per the application you can apply early, but I believe that the certifications you're going to certify are still saying that you're not going to reduce your FTEs, or you haven't reduced your FTEs for the full 24 weeks, or reduce pay for the full 24 weeks. So yes, you can apply early, but a lot of businesses, if you have the option to use the 8-week period, you're going to be at a decision point, because you may want to stick to that 8-week period because you don't know what your business is going to look like over the next month or two. And you may end up needing, unfortunately, to cut some wages or cut some FTEs. So it's definitely a decision point, and something that you probably want to work with, your trusted advisor or CPA to get to a conclusion on. but you can apply early. And I think that was the question. Josh, repeat the question to me one more time, make sure I understood it.
The question is, can you revisit the ability to apply for forgiveness before the end of the PPP covered period, and what will be required?
Yep. And so the what will be required part, unfortunately, I don't have specifics. Hopefully you can use the EZ form, but it's going to be just like when you were applying for the PPP loan, and we're having to rely on the lenders. So you're going to have to rely on your lender. Your lender is going to have a punch list of items they're going to want to see from you. And so it'll be interesting to see what those lenders want you to provide, but they're going to be the ones that tell you what they want to see for your forgiveness application.
Thank you. The next question that we have is, can you repeat, if you took the loan before June 1st, you have to use the 8-week period versus the 24-week period. Is that correct?
So if you took the loan before June the 5th, you have the option to use either the 8-week period or the 24-week period. So that's the key decision point if you've had the loan. And that's going to be, can you use the loan money appropriately within 8 weeks? And if you can stick to the 8-week covered period. You may want to base your forgiveness application on the 8-week covered period. Again, you don't have to, and I would tell everybody, you might not want to be in a huge rush to apply for forgiveness. No payment is due for 10 months. And so there is constantly new information coming out. And, we may get a full forgiveness if your loan was under $150,000. So I would just encourage people to be patient on applying for forgiveness, just so more information can come out. And the more information we have, the better decision you can make.
That's great information. The next question that has come in is the PPP forgiveness reduced by the amount of the, I assume it's an EIDL, the EIDL you've received?
No, it's reduced by the amount of EIDL, which I'm going to talk about in my next little bit. If you receive the emergency grant from the EIDL, you can't receive the emergency grant from the EIDL and get full forgiveness for your PPP. You will have to repay the EIDL emergency grant. But you can have the EIDL and the PPP loan. You can't have both of those. And I'm going to talk about that in my next bit.
Pause for just one moment and see if any additional questions come in. And hopefully we got those answered. And again, anything that's not answered in this presentation, we can try to secure some answers and follow up to this webinar. Doesn't look like we have any additional questions, Drew, if you want to continue the presentation.
All right, and my contact information, thanks to my marketing person, is right above my shoulder here. So jot down my email address, my phone number. Happy to help anybody when this is over with. And so continuing on, so that is my bit about the PPP. And I didn't want this to only be about the PPP. And so we're going to discuss some other incentives and tax items that I think are important. And the next one, as Josh, one of the questions alluded to, is the Economic Injury Disaster Loan, the EIDL. This is an SBA program that has been in existence prior to the CARES Act to assist businesses in disaster areas. It has been updated and revamped by the CARES Act. So it is designed to provide economic relief to businesses that are currently experiencing a temporary loss of revenue. Proceeds can be used to cover a wide array of working capital and normal operating expenses, such as continuation of healthcare benefits, rent, utilities, and fixed debt payments. It cannot be used to replace lost sales. You can't expand your business on this loan or refinance other long-term debt. Unlike the PPP, this loan is not forgivable. But this loan is more flexible. It's more flexible in what you can use the money for. The appropriated funds for $10,000 emergency grants have ran out. And so the CARES Act did put a $10,000 emergency grant that was issued when you applied for the EIDL. Many people applied, got the grant, and did not even want the EIDL loan. And so that has ran out, unfortunately. And I haven't heard anything if those grants are going to come back that may. I really do not know. And as I've mentioned before, you can have both the PPP and the EIDL, but they cannot cover the same expenses. So, of course, you use up your PPP money, use that for your payroll, and then use EIDL for other items, or use it after you've used up your PPP money. So who is eligible for the economic injury disaster loans? You must be experiencing a substantial economic injury. You must qualify as a small business under the SBA guidelines as modified by the CARES Act, generally very similar to the PPP. Your business has less than 500 employees. The loan is limited to $150,000. So the original EIDL, I believe, were loans up to $2 million. And so the SBA has dialed that back to try to provide more relief to more businesses. The interest rate for these loans is 3.75% for small businesses and 2.75% for private nonprofit organizations. The maximum term is 30 years, but is determined on a case-by-case basis based on the borrower's ability to repay. The SBA does require collateral on all loans over $25,000, and payments on these loans are deferred for 1 year. And this is another lending program I just wanted to briefly mention. I don't know a heck of a lot about it, and I think they're going to send out my slides, and so I wanted to put the link to it here at the bottom. But the Federal Reserve established this Main Street lending program to support lending to small and medium-sized businesses and nonprofit organizations that were in sound financial condition before the onset of COVID-19 pandemic. This lending program is administered by eligible lenders, and so you can find that who's an eligible lender on the website. Loans are full recourse and not forgivable. So again, not a forgivable loan. But for those businesses out there who are struggling and were doing great before all this, and they just need some money just to keep chugging along, this may be an avenue for that. So let's talk about the employee retention credit. If the PPP was the top incentive for the gold medal winner of the CARES Act, then the employee retention credit is definitely the runner-up. I would call this the second best incentive. And I'm going to jump ahead here and go ahead and say, but if you receive the PPP loan, you cannot participate in this employee retention credit. So you can only participate in this if you did not receive a PPP loan. So most businesses who wanted relief have probably got the PPP, but maybe they didn't, and maybe this is a really good option. So the employee retention credit is designed to encourage employers to keep employees on their payroll. And same thing as the PPP. So it's a refundable tax credit of 50% of up to $10,000 in wages per employee. So $5,000 of credit, essentially. Eligible employers do include tax-exempt organizations. Okay, and so employers are eligible for the credit if they operate a trade or business during calendar year 2020 and experience one of two things: either a full or partial suspension of operations during any calendar quarter due to government orders. So you're a restaurant or you're a gym and you had to shut down, or you're still shut down, then you qualify right off the bat for that quarter. Or you have a significant decline in gross receipts or sales. And a significant decline in receipts begins on the first day of the first calendar quarter in 2020, for which an employer's gross receipts are less than 50% of what they were in the same calendar quarter in 2019. So you look at a calendar quarter in 2020 compared to the same quarter in 2019, if your gross receipts were less than 50% of what they were in 2019, well, then you qualify for this, even if there was no partial or full suspension because of a government order. And so, then the next question is, well, when does it end? When does my eligibility end if I had a decline in gross receipts by more than 50%? Well, the significant decline in gross receipts ends on the first day of the first calendar quarter following the calendar quarter in which gross receipts are more than 80% of what they were during the same calendar quarter in 2019. So maybe Q2 of 2020, your business just plummeted and your gross receipts were less than 50% of what they were in Q2 2019. Q3 comes around. So, hey, you're eligible now. You're eligible in Q2. Q3 comes around and you pick back up business. And so at the end of Q3, you now have at least 80% of the gross receipts that you had in calendar year Q3 in 2019. Well, then the program ends for you. You would have been eligible for Q2 and Q3. These are qualified wages paid by an eligible employer from March 13, 2020 through the end of this year. And as I said, and I'm going to reiterate, if you get a PPP loan, you're not eligible for this incentive. All right, and so different size companies are treated different for this employee retention credit. It depends on the number of employees you have, of course. So if you have less than 100 employees, the credit is based on qualified wages paid to all employees, whether they work or not. If you have more than 100 employees, then the credit is only allowed for qualified wages paid to employees for time they're not providing services. So if your business has more than 100 employees, this credit, qualified wages, are only wages paid to employees who essentially were not working. But less than 100 employees, you can get this credit for all employee wages, whether they work or not. And so to claim this credit, employers report qualified wages for each quarter on their quarterly employment tax returns, or Form 941. The credit is taken against the employer share of Social Security tax, and the excess is refundable. And so a $5,000 credit, doing the math on this, is going to exceed the Social Security tax. And so it's going to be refundable, meaning you're going to have more credit than you do in Social Security tax on your quarterly employment tax return, Form 941. And so you would be eligible. I can't think of a scenario, I'm sure there is one, where you would not be eligible and get a refund. And this is something that our clients have had great success, the ones that have participated in this and I've worked with, working with your payroll provider. I know ADP, Paychecks, and I can go on about all the payroll providers. They all have ways to enter this and to keep track of this and to help you get this credit. And so I would work with your payroll provider on this. So the next item here is net operating loss rules, or NOL rules. Beginning with NOLs created in tax year 2018, NOLs were only eligible to offset 80% of taxable income in future years. And this limit has been removed for tax years 2018 through 2020 as part of the CARES Act. And so, not trying to dumb this down or, offend anybody, but net operating loss is just you had more expenses than you did income. This most of the time only applies to C corporations, but it also could apply to you as an individual if you have businesses that pass through income and losses to your personal tax return, or you have a Schedule C business, you're a sole proprietor or independent contractor, you may have an NOL as well. NOLs carried to 2019 and 2020 can offset 100% of taxable income. So if you had a $100,000 loss in 2018, and in 2019 you had $100,000 of income, pre-CARES Act, you could only offset $80,000. 80% of your 2019 income. And so you would still have to pay tax on $20,000. Well, after the CARES Act, they removed that barrier and said, no, if you had a $100,000 loss in 18 and $100,000 of income in 19, well, then you can use up that NOL and bring you down to zero. But here's the real big incentive. NOLs for tax years 2018 through 2020 are also eligible for a 5-year carryback. And previously, no carrybacks were allowed. So the ability to carry back these NOLs is huge. If you had an NOL for one of these years, you would be carrying that loss back. If you had an NOL in 2018, you would be carrying it back to 2013. And 2013, 14, 15, 16, 17, all those years were higher tax rate years, especially for C Corps. And so you would be carrying that loss back to a higher tax rate year and getting a refund of those taxes. So that's why this is a big incentive for businesses. If you know you're going to have an NOL in 2019, or if you had one in 2018, be working with your accountant. We've already done this for some clients and carrying it back and getting a refund. Just another way to put cash in a business that might be struggling. All right, the next item is qualified improvement property fix. QIP, qualified improvement property, is generally defined as improvements made to the interior portion of a building after the building is placed in service. And so this is the interior portion of a commercial building, not a residential. And after being placed in service doesn't necessarily mean that the taxpayer who made the improvement is the taxpayer putting it into service. It mainly excludes if you build a new building and then improve the interior, that doesn't qualify. But if you bought a new building, commercial building and office space, whatever, and you improve the interior of that building, then it would qualify. And so a drafting error in the 2017 Tax Cuts and Jobs Act left QIP with an unintended 39-year depreciable life. So did anyone out there know that Congress makes drafting errors on legislation? It is very confusing. And you would assume that anybody who rushes through significant tax legislation, that there wouldn't be errors. But what do we know? There wasn't a major error. And so we have finally got the correction. The CARES Act corrects this drafting error to allow QIP to have 15-year depreciable life and 100% bonus depreciation. And so you may be thinking, if you have a business, or if you know somebody had a business who had a significant, refresh or remodel on the interior of their business, well, now for tax purposes, you've gone from having to depreciate that improvement over 39 years to now being able to fully write it off, 100% bonus depreciate it in the year that it happened. Not only that, this change is retroactive for tax years 2018 and 19. So, if you had this, a big improvement, remodel in 18 or 19, talk to your CPA. I mean, this is something that could be significant tax savings for you if you had this improvement, and you can expense this improvement. And so now I want to kind of spend the next few minutes just talking about a couple of individual tax incentives that have come out as part of the CARES Act and are most likely going to be part of CARES Act 2.0. And this next one here, personal tax rebates or economic impact payments. This is what everybody was talking about, the news was talking about, because this is what affected the majority of Americans. The Treasury Secretary, Steve Mnuchin, has actually said over the weekend or last Friday that this will be part of the next stimulus package. And it sounds like essentially the same rules. If anything, the amount of rebate that you get for kids under the age of 17 may be increased. So I want to make sure I mention this and talk about this. Rebate amounts were based on your 2019 tax return. If you hadn't filed your 2019 tax return, it was based on your 2018 tax return. Or maybe you filed your 2019 tax return and you had a significant amount more income and you were shaking your head, darn, I wish I wouldn't have filed that because 2018 I had less income and I would have qualified for this rebate. Well, that's unfortunate. So the amount of the rebate is $1,200 if you're single, $2,400 if you're married, plus $500 for each child under the age of 17. That's your rebate amount. And I want to say this is really considered an advanced rebate of your 2020 taxes, or an advance based on 2020, but obviously 2020 is not over. So they're based on your 2019 or your 2018 tax return. And so of course there is a phase out. The phase out of this rebate begins at AGI of $75,000 for single and $150,000 if you're married. So if you're single with no kids, you're fully phased out, meaning you don't get any rebate at AGI or adjusted gross income of $99,000. If you're married with no kids, you're fully phased out at $198,000. And so essentially the way the math works is, you take your AGI and subtract out, if you're single, subtract $75,000 if your AGI is over that, times 5%, that's your reduction. So 99,000 less 75,000 times 5% is $1,200, and you're fully phased out. And obviously, if you have kids and you're getting $500 per kid, then it's going to take a higher AGI to fully phase you out of the rebate. And a question that I have received numerous times over the last few months when people got these rebates and the banking apps were crashing because everybody was trying to log on to see if they had got the rebate, is these rebates are not taxable. So you're not going to be taxed on these rebates. In fact, when you file your 2020 tax return, you will reconcile your advance payment, your rebate that you received, against your 2020 AGI. If you are due more than what you received, you will receive additional tax credit on your 2020 tax return. And here's the icing on the cake. You will not have to pay anything back. So you reconcile it to your 2020 AGI, and really based on your 2020 AGI, you shouldn't have gotten any rebate. Well, so far there, the CARES Act says, and the guidance that we received is that you will not have to pay anything back. And the IRS has a website for these economic impact payments. If you have additional questions or want to calculate your payment, you can go onto their website there. All right, and the last item I kind of want to touch on is this is just another way to kind of help folks out during this time, is there are a number of reliefs from retirement plan rules. And so one of those is a coronavirus related distribution is a distribution to a qualified individual of up to $100,000 between January 1st, 2020 and December 31st, 2020 from an IRA or a qualified retirement plan. And so a qualified individual for this purpose is somebody who has been diagnosed with COVID-19, whose spouse or dependent is diagnosed with COVID-19, or has experienced adverse financial consequences as a result of the virus. And so, if you've lost your job or, you need, you're struggling financially, you can take up to $100,000 distribution from your qualified retirement plan or IRA. And typically, if you're under the age of 59 and a half, a 10% penalty applies to that. Well, in this case, there is no 10% penalty. And so the distribution is taxable. So you will pay tax, but it is taxable over 3 years. So you would divide it over 3 years to then pay tax on that amount, unless you opt out and you just want to go ahead and pay tax on it in year one. Also, these distributions can be repaid or rolled over into another qualified plan or IRA within 3 years, and then they could be excluded from income. So maybe you've taken this out as precautionary, and then you decide, hey, I really didn't need that. I'm going to pay it back. So you can pay it back and it's not taxable. But if you pay it back in year two, well, you've already picked up a third of it into income for year one. You could then go back and amend your first tax return from the first year you took the distribution to exclude it and get a refund of your taxes. And the next item of relief from retirement plan rules, the maximum loan amount from a qualified plan is increased to $100,000 from $50,000 for the period beginning on March 27, 2020 until September 23rd, 2020. So a qualified individual, same qualified individual as the previous slide, with an outstanding loan on or after March 27, 2020 from a qualified employer plan, the due date for any payments are delayed for 1 year. And so this is just another, the IRS and Treasury trying to be flexible and allowing people to get their hands on some cash. You can now take up to $100,000 loan from your qualified plan being something like a 401k plan to kind of help you during these times. And then the last item here is required minimum distributions, or RMDs, are not required in 2020 from qualified plans or IRAs. So you have many people who typically who are over the age of, I think the age now is 72, it was 69 and a half, who are required to take minimum distributions from their retirement accounts. Well, they don't have to take them during 2020, and some people may decide not to do that. And if you have already taken your RMD for 2020, you have until August 31st, 2020 to put it back in and then you won't be taxed on it. So just another little incentive there for those that don't need to take any extra cash. So with that, I'm going to wrap it up here and open the door and see if anybody has any questions on what we've discussed. I really hope that I didn't want to spend the entire time just talking about PPP, and I wanted to be able to talk about some of these other incentives because I hope that this is something that can help you out personally or help your business or a business that you know in your community that may be struggling. We're happy to help anybody who has questions. Please reach out to me. And if you're CPA, you need CPE credit for this webinar, I've been told to be on the lookout for a follow-up email on the next steps to get your CPE certificate. You will need the course code on the bottom of this slide, DMJ Tax 2020, exclamation point. So with that, I'm gonna open it back up to Josh and see if we have any questions hanging out there. Please feel free to ask any questions you may have.
Yeah, thanks, Drew. I do want to revisit. We got a question after we started back on PPP, and just want to ask that one and follow up. The question is, I know you're past the PPP section, but are the PPP funds taxable? If the funds increase your profit, do you have to pay tax on that increase?
This is a fantastic question, Josh. And in the CARES Act, it says that the PPP funds, forgiven funds, are not taxable. Well, press pause. The IRS came out with a notice soon after all this that says, okay, it's not taxable when it's forgiven, it's not taxable, but the expenses you use that PPP money for are no longer deductible. And so if you got a $100,000 PPP loan forgiven and you use that $100,000 for payroll, okay, you don't have to include the $100,000 in income, but you do have to exclude $100,000 of payroll expenses. And so in my mind, you're right back to just saying that it's taxable. And so this has kind of been another point of contention in Congress and something that we could see change. And it would be great if we saw it change because this is beneficial, but really right now it is taxable no matter how you look at it. So it will increase your profits. So
thank you. Here's another question. A little bit, I guess, on a positive note. What about companies that are substantially affected in a positive way and could not get the banks to help with additional working capital, so they used IRA dollars to fund growth? Can I get the same IRA help? Is the question.
Yeah, so as far as I'm concerned, the IRA help, you have to be a qualified individual, as I discussed. So you can go on the IRS website. It does give a lot for the last bucket there, that catch-all. But as far as I know, you have to either be diagnosed with COVID-19, which I hope nobody has been and doesn't get diagnosed, or your spouse or your dependent is diagnosed, or you experience adverse financial consequences. And that's for a coronavirus-related distribution and for a loan that's larger. Now, the RMD situation where you don't have to take an RMD, you don't have to be a qualified individual. That applies to everybody. So unfortunately, I think you have to fall in that bucket as a qualified individual in order to get kind of that IRA relief.
Thank you. The next question that we have, and I'm going to leave it up to the tax expert to help interpret this. Can you discuss the tax treatment of ERC? Question is the question.
So the ERC, employee retention credit. So that credit, whatever credit you get, just like any other credit, you will have to reduce your payroll expenses by that credit. Similar to the whole PPP not being taxable, the IRS doesn't look friendly on a double dip. And so that's really the way that would be looked at. And so, yes, essentially any ERC credit you receive is rolling in a taxable income by reducing your payroll tax expense.
The next question that we have somewhat relates back to that positive case that we had where the pandemic has had a positive impact. Is the unexpected growth in that business, is it considered an adverse consequence from a tax perspective?
You know, I would have to go on to that IRS website. They do have, you know, I believe they're referring to adverse as negative, but I mean, maybe you can make the argument that adverse is an unexpected positive. I mean, I don't want to be held to any advice on positive and that falling in there, but maybe so. That's the classic accountant response is it depends, right? It depends. That's what we always say. It depends.
So I'll pause here just for a moment and see if we have any other questions come in from the audience. Looks like you might have answered a lot in the first break. I know there's a lot of questions as it relates to that specific program. We're not seeing anything coming in on our Q&A board, and being respectful of everybody's time. And I want to really thank Drew and thank DMJ and company for their sponsorship of today's important professional development opportunity. This concludes today's webinar. We hope NCDA members and our guests found this discussion valuable. Our thanks again to NCDA's annual sponsors for their year-round support for learning programs like this. Many of you have already planning to join us tomorrow for the first in a three-part webinar on marketing, branding, and communications. At 11 a.m. tomorrow, experts will offer insight on why now is the time for a marketing refresh. Marvin Price of the Charlotte Regional Business Alliance will moderate that session, and you don't want to miss that. Otherwise, we'll hopefully see all of you at the annual conference, which will take place virtually on August 26th. Watch your email for more news about what's on the horizon. In the meantime, stay connected, stay confident in your abilities, and stay cool from Brevard. Thank you.